Thank you, Karen, Scott, Karen, Melissa, and Brianna for the comprehensive discussion on the marketing rule. I'm sure it was well received. Our next panel will focus on a variety of topics for registered investment advisors. Ryan Henson will moderate the panel. Ryan is a regulatory counsel from the Los Angeles Regional Office. The panel is going to discuss an advisor's fiduciary duty and compliance programs, including annual reviews, Form ADV observations, and assessments of compensation arrangements. Ryan, I will hand the microphone off to you.
Thanks, Marshall. Before we jump into the substance of today's panel, allow me to just do a quick introduction of the panelists that we have with us today. We have a great panel for you all. We have Anna Sandor. She's the senior counsel in the Chief Counsel's Office of the SEC's Division of Investment Management. She's located in the home office. We have Colin Forbes. He's an assistant director in the SEC's Enforcement Division. He works in the Asset Management Unit and is located in the Boston Regional Office. We have Aaron DeAngelis. He is an exam manager in the Division of Examinations and is located in the Philadelphia Regional Office. And we also have Jim DeSidicki, who's the General Counsel and Chief Compliance Officer at Sanders Capital, LLC. We also have one housekeeping item. There is an opportunity for you to communicate questions if you have them for the panel. So please email your questions to complianceoutreach@sec.gov, and we will try to answer them. There's also a link to submit questions under each of the panels in the agenda posted on www.sec.gov. So let's turn to our first topic, fiduciary duty. Anna, from IAM's perspective, could you give us a high-level overview of the SEC's rules and interpretations, sort of addressing the obligations of investment advisors when they provide investment advice to clients?
Yes, sure. I'm happy to be here and share my thoughts on the omnipresent and yet also very timely topic of an advisor's fiduciary duty. So I say timely because it has been a little over 5 years since the fiduciary interpretation was adopted by the Commission in June 2019. So at this point, advisors have had a considerable amount of time to adjust business operations, compliance practices as needed to ensure that they're meeting their fiduciary standard of conduct consistent with the requirements in the interpretation. And I also think it's timely because I think standards of conduct are really front of mind for many advisors right now. The 2025 examination priorities report, of course, highlighted meeting fiduciary standards of conduct as a continued exams priority, especially with respect to recommendations involving certain types of products. And also, advisors providing advice on transactions involving retirement assets have also likely been thinking a lot about standards of conduct with all the recent activity with respect to the DOL's investment advice fiduciary rule. So so for that reason, I do think it's a good time to, circle back on the topic, kind of remind ourselves of where we came from and where we are now. Very briefly, where we came from, I'm sure everyone here is well aware, everyone listening, I should say, is well aware, but the Commission adopted the package of rules and interpretations in 2019 to address issues that the Commission had been considering for nearly 2 decades prior, specifically investor confusion regarding the differences between broker-dealers and investment advisors. The package included, of course, Reg BI, which imposed a new standard of conduct for broker-dealers, a new Form CRS relationship summary with easy to understand disclosures for retail clients and customers, and then 2 separate interpretations under the Advisors Act. First, the Commission interpretation regarding standard of conduct for investment advisors, which we will focus on today and is commonly referred to as the fiduciary interpretation. And then a separate interpretation about the solely incidental prong of the broker-dealer exclusion from the definition of investment advisor. So Yeah, as I said, I'm sure everyone here is already deeply familiar with each of these documents, but of course, if you'd like to reorient yourself, they are linked on the SEC Spotlight page for Reg BI. And I'll just take a moment to just briefly highlight some of the principles, the key principles reflected in the fiduciary interpretation, which reaffirmed and in some cases clarified certain aspects of the fiduciary duty that an advisor owes to its clients under the Advisors Act. Some principles include the fact that the fiduciary duty is made enforceable by the anti-fraud provisions of the Advisors Act. It is principles-based, applies to the entire advisor-client relationship, is comprised of both a duty of care and a duty of loyalty. The duty of care requires an advisor to provide investment advice in the best interest of its client based on the client's objectives. And includes, among other things, the duty to seek best execution of a client's transactions, where the advisor has the responsibility to select broker-dealers to execute trades, and the duty to provide advice and monitoring with respect to ongoing relationships. And then under the duty of loyalty, an advisor must not place its own interests ahead of its client's interests. And of course, in order to meet this duty, an advisor must make full and fair disclosure to its clients of all material facts relating to the advisory relationship, and must eliminate or make full and fair disclosure of all conflicts of interest, which might incline an advisor to render advice which is not disinterested, such that a client can provide informed consent to the conflict. That's a mouthful. So together, we usually characterize all of these obligations as just requiring the advisor to act in the best interest of its client at all times. And an advisor cannot place its own interests ahead of the interests of its client. So since the interpretation went effective, SEC staff have released numerous pieces of guidance to help advisors implement these requirements. Of course, I think we all know staff guidance just represent the views of the staff. They're not a rule, a regulation, or statement of the commission, but they do help compliance professionals understand the staff's views on how the responsibilities of a fiduciary can translate into an advisor's obligations to clients every day. So I will flag just some pieces of guidance that we have published since the interpretation went effective that I think are helpful. We have issued a series of staff bulletins in the form of questions and answers on how broker-dealers and advisors can satisfy their obligations under Reg BI and the fiduciary duty. There have been 3 that we have issued. In March 2022, we issued one that focuses on account recommendations and the obligations that apply to those. Then in August 2022, we published one on conflicts of interest, which really emphasized the staff's view that identifying and addressing conflicts should be robust and ongoing process tailored to each conflict, and also provides helpful guidance on steps firms can take to identify conflicts, as well as steps to address those conflicts through elimination, mitigation, or disclosure as appropriate. And then lastly, in April 2023, we published one that focuses on the duty of care and discusses relevant factors advisors can consider when considering costs and reasonably available alternatives and gathering and assessing an investor's investment profile information. So in addition to those bulletins, we've also issued some FAQs, which are, of course, responses to frequently asked questions. The first one that I want to flag is in March of 2022, we issued an FAQ clarifying the staff's view that an advisor can use the term fiduciary or fiduciary duty on its Form CRS, but only to the extent permitted by the form and its instructions. And we cautioned advisors against using these terms, where doing so would be extraneous or would involve kind of exaggerated claims. And then subsequently in October 2022, we issued another FAQ that clarifies the staff's view that an advisor that recommends other advisors to its clients may, in making that recommendation, consider factors relating to DEI, diversity, equity, and inclusion, consistent with an advisor's fiduciary obligation, provided that, it's the use of such factors are consistent with other things like the client's objectives and the scope of the relationships, disclosures, et cetera. So I'll just end on that, but I will say that for those of you listening who work at a dual registrant, of course, you know that you must be mindful of the separate standard of conduct requirements outlined in Reg BI. And there's a lot of guidance out there specific to that we're not going to talk about. But, Trading and Markets has numerous FAQs on Reg BI on their website. And there's also a super helpful Reg BI small entity compliance guide that I'll just flag as well.
Thank you so much, Anna. So in addition to the 2019 fiduciary interp, is there any additional staff guidance that I think folks can look forward to in the future from IM, or is there anything that you can talk about?
So perhaps unsurprisingly, I cannot comment on any future or forthcoming guidance at this point from IM. That said, I do think it's important that advisors not just consider the fiduciary interpretation in isolation, but also consider the existing sources of guidance that I just flagged earlier. And I'll also note that, of course, IM staff continually engage with the industry to discuss new issues, and we greatly appreciate it when folks reach out with questions or just raise issues or operational challenges that we might not be aware of. I know this is an age-old issue, right? Fiduciary duty, but we know that there will continue to be emerging fiduciary issues due to changes in the market or technological advances and other types of innovations. So if there are any topics where you think that guidance would be merited, or if you just have questions, please feel free to reach out to staff to discuss. And I'll just note that IM Chief Counsel's office has an email. It is imocc@sec.gov, although I'm sure some of you have heard that a couple times mentioned already throughout the panels today.
So Anna, does that email go directly to you then?
To myself and all my colleagues. So we will respond to those emails.
Great. Aaron, I see that you were able to join. Are you? Can you hear us or?
Yes, hopefully you can hear me. I'm sorry, I had some computer issues.
No, we're glad that you were able to join. Thank you. I did want to turn quickly to you after talking about sort of these fundamental fiduciary duty type issues, and just get a little bit of the exams perspective. Are there any common fiduciary duty issues that you and your teams are seeing?
Aside from the usual ones that everybody is aware of, client suitability, compensation arrangements, improper or no disclosure regarding conflicts of interest and other things, one trend that we're seeing a lot of is newly formed investment advisors that were registered reps of broker dealers that they left their brokerage firm, became an investment advisor, and they're now just charging investment advisory fees, but they're also still affiliated with their broker dealer and getting commissions, and which is a conflict. In addition, they are under the impression that when the brokerage firm comes in and does their annual look at them and due diligence, that suffices for their annual review, which is not the case. The annual review is different and geared towards the Investment Advisors Act versus the different things that the broker dealer is looking at when they're doing their due diligence or their review of the registered rep of the broker dealer. So that's one that we're seeing a lot more of because of the conversion from a lot of registered reps of broker dealers moving to the investment advisory business.
That's great. Thanks for that. Colin, let me turn to you because over the past few years, it appears that enforcement has been, somewhat active in the space of dealing with fiduciary duty issues. We've seen some actions brought, dealing with the wrap accounts and leveraged ETFs and share class. And could you talk to us a little bit about what you're seeing from enforcement side and sort of the issues that you've been dealing with?
Sure, absolutely. Thanks, Ryan. And of course, enforcement works closely with IM and exams on these issues. I won't recap, obviously. Anna gave a great kind of overview of the fundamentals here, and I won't rehash that. But as she noted, there's both a duty of loyalty and a duty of care inherent in the fiduciary duties of investment advisors. And most, if not all, of the cases that enforcement is bringing with respect to investment advisors, and in this space, deal with one or the other of them. It's sort of the backbone of an enforcement program, of our enforcement program with respect to advisors. To the extent the issues that you mentioned in your introduction, to the extent it would be helpful to this group to talk about some recent examples of enforcement actions as illustrations of this. You mentioned, Ryan, share class selection and cash sweep account, or share class selection. I would also bring in cash sweep accounts. Yeah. That's an area where enforcement frequently is seeing issues that result in enforcement actions, and investment advisors can violate both a duty of loyalty or a duty of care in this space. And so, by way of a recent example, in a recent case, the GA Repl case from just recently, that case is from the end of September of this year. It involved loyalty issues with respect to the failure of the advisor to disclose conflicts of interest associated with mutual fund share classes that it was recommending for clients, because the advisor was placing clients in share classes that for which it received fees, 12B1 fees, and at the same time lower cost share classes of the same funds were available. That's a pretty typical fact pattern that we've seen going back years in the past, and that we continue to see, and that's a good recent example of it. And it's a very similar issue with cash sweep. Cash sweep money market funds. Repl was receiving revenue sharing payments from its clearing broker and making recommendations for cash sweep money market funds and not disclosing the associated conflicts with that. And then likewise, that case involved no transaction fee mutual funds, and Repl was again receiving revenue sharing from its clearing broker there, and that wasn't adequately disclosed. And so, in line with the issues that Anna was talking about, there's a duty that an advisor has to disclose material facts, and those would include the conflicts. And so if advisors are not careful to make adequate disclosures or otherwise deal with those conflicts, they can run into problems. Repl also involved the duty of care, and I should note that there was a best execution issue with respect to mutual fund and money market share classes. There were cheaper share classes available, and so this implicates both a duty of care and a duty of loyalty. Repl didn't analyze whether the share classes that it was advising clients to invest in were in their best interest. Another example of a very similar case, Cataray Grant from August of this year. But again, as I mentioned, these are issues that come up frequently in enforcement actions, and that I anticipate, to the extent exams is seeing these issues in their examinations, or enforcement otherwise learns of issues like these, I anticipate that we'd continue to see enforcement actions like this. Wrap fees, as you mentioned, Ryan, are another kind of fertile ground for potential issues, potential fiduciary breaches. One issue that can arise that we've seen in a recent case, the Waddell and Reed case from September of 2022, involved reverse churning, and so that's where clients in a wrap fee program are paying a wrap fee, but if to the extent that there's not sufficient trading activity in their accounts, it may not be appropriate for a client to be in that arrangement. And the Waddell and Reed case involved a failure to follow up and assess whether certain clients were appropriately put in that, and that violated a duty of care. Another similar case from 2022, Kovac Advisors. Of course, another way that wrap fee arrangements can present fiduciary issues that could rise to the level of enforcement is kind of similar to the share class selection issues that I was just addressing, where you have financial incentives or even share class selection issues in a wrap fee context that present issues. And just recently, the Enforcement Division brought an action against JP Morgan Securities that involved a duty of loyalty breach, a failure to disclose that JP Morgan and its reps had an incentive to recommend that clients put assets in JP Morgan's wrap fee program as opposed to other third-party wrap fee programs, because in that context, JP Morgan was able to charge a higher wrap fee for the program. And the reps also had certain thresholds that they were required to meet in terms of assets held in the program, and those presented conflicts that were not adequately disclosed. And so that case involving a $45 million penalty was just recently brought by enforcement. There are other issues that can come up in a wrap fee context and other recent cases that illustrate them. So, for example, the Wilmington Trust case from October of last year involved both loyalty and care issues. Wilmington Trust had avoided paying certain transaction fees on behalf of wrap fee clients by investing them in higher cost share classes or in other products in the same sector that had higher expense ratios, and did not disclose the financial incentive, the conflict that presented, and also failed to analyze whether the share classes and products that they were recommending were in their clients' best interest. And so that presented both care and loyalty issues. And finally, in this space, I'll just mention, and again, these are illustrative. This is not an exhaustive list by any stretch, but the Merrill Lynch case from April of 2023 involved duty of loyalty issues. Wrap fee clients were paying a program fee in exchange for certain services, but Merrill failed to adequately disclose that that certain production credits, which were essentially commissions, were being charged on foreign exchange transactions. And they were often larger than certain markups that were being disclosed. And again, this failure to disclose those fees presented a duty of loyalty issue and a breach. And finally, another category you had mentioned, Ryan, is leveraged ETFs. And I would just speak more broadly about leveraged ETFs, or really any other kind of potentially exotic or structured products could potentially present fiduciary issues in an advisory context. And so a good example of this from September of this year, so a very recent case, is the Vora Wealth Management case. And in that case, an advisor was selling clients annuities and replacing them with certain equity-linked structured notes that carried the risk of total loss and were inappropriate for certain clients given their profiles, their income goals, their net worth, and their overall profile. And so that presented a duty of care issue. It also presented a duty of loyalty issue because the advisor received over $30,000 in undisclosed benefits from the broker through which they had purchased the notes. And so that's a good example of the types of fiduciary breach issues that can come up in this space that could result in an enforcement action. Another good example from September of last year, the Summit Planning Group case involved certain VIX-linked notes that an advisor was causing clients to hold for lengthy periods that were inconsistent with the prospectus for these notes. The VIX is the so-called fear gauge. It's a volatility index. And these notes were designed to be held for a short period of time. And the advisor, frankly, did not understand that aspect of the product. And so in failing to understand that and failing to really understand the advice that it was providing to its client, that the advisor violated its duty of care. So I think, again, this is not an exhaustive list, but just addressing each of these topic areas, I think is a helpful illustration in a specific case context of the types of broader issues that Anna was going over.
Colin, just a quick follow-up question, because these products are always very interesting to me. And when we talk about these types of, sort of exotic or, volatile products and holding them for very lengthy periods of time, there are, as you were saying, duty of care and duty of loyalty issues, and the duty of loyalty dealing with sort of conflicts. Are you seeing deficient disclosures with respect to these conflicts? Are you seeing no disclosures at all, or are they just inadequate? What typically are we seeing with respect to disclosures?
It really varies from case to case, Ryan. I think, and I'm sure Aaron would see a similar issues in exams, but I think on certain occasions you see advisors are efficient for the client to understand the conflict. In other instances, there's a wholesale absence of disclosures, or, for example, there's a disclosure of one particular conflict, but some other conflict. For example, one payment is disclosed, but another payment is not, and that can be misleading. So it's hard to give a general answer to that question because it varies so much from case to case.
No, I appreciate that. Jim, let me quickly turn to you. As our industry, representative here, have you found the Commission's guidance in this area to be helpful?
Yeah, I have. I mean, as I had mentioned to Anna previously, I do think sometimes it's from an indexing perspective. Sometimes it can be difficult to find the exact. If you read through the FAQs, you actually find that there is something on point, but sometimes it can be a little bit challenging to pinpoint quickly exactly the information that you need. But I think generally it is quite helpful.
Okay. I want to now shift gears in the interest of time and move to our discussion about compensation arrangements, and because it sort of keeps.
Can you hear me now? Can you hear me now? Can you hear me now? Okay, someone else should go. We'll circle back.
I can hear you now.
Comp or benefits in connection with the investments it recommends and the services it provides can result in conflicts of interest. So, and of course, advisors have numerous types of comp models and arrangements with their clients and third parties. These arrangements continue to evolve, anything from the traditional asset-based fees to subscription-based fees to non-standard arrangements. And then, of course, advisors can receive other forms of comp from third parties or, for directly or indirectly for recommending investments or using certain service providers. So, infinite different types of conflicts can present here. And, these types of scenarios might incline an advisor to place their interests ahead of a client's interests and, of course, render advice which is not in their client's best interest. So, turning to the fiduciary interpretation, of course, as I feel like we've now repeated many times, right, the fiduciary interpretation makes clear an advisor always has a duty of care and loyalty obligations and must act in a client's best interest. So how do you go about doing that when you have all of these conflicts related to comp arrangements and fees? The interpretation says, first advisors should identify these conflicts and then address them, right, through elimination or mitigation through disclosure. In terms of identifying the conflicts related to comp, I would direct folks to that staff bulletin on conflicts of interest that I mentioned earlier. It actually provides specific examples of compensation-related conflicts, including third-party comp incentives. And additionally, I would also direct compliance professionals to check out some FAQs that we published in 2019. It's got a long name. The title is Regarding Disclosure of Certain Financial Conflicts Related to Investment Advisor Compensation, but generally. And then, the second part of the fiduciary interpretation suggested approach that I mentioned earlier is, of course, to, after identifying the conflict, an advisor must either eliminate it or adequately mitigate the conflict such that full and fair disclosure and informed consent are possible. What constitutes full and fair disclosure of all material facts is tricky, right? And I would direct people to look at the specific guidance in the fiduciary interpretation that talks about that and provides pretty specific guidance on what qualifies as full and fair disclosure. And those two other pieces that I just mentioned, pieces of guidance that I just mentioned, the staff bulletin on conflicts of interest, as well as the FAQs on conflicts related to compensation, also, I think, provide a lot of helpful guidance on how to mitigate these types of conflicts related to comp, and also how to disclose them. So, for example, the bulletin provides specific factors that firms should consider when determining their approach to mitigating compensation-related conflicts and measures to adopt related to compensation arrangements, and actually provides specific disclosure tips, which are super helpful. And then, of course, the FAQs that I just mentioned provide specific examples of material facts that the staff believe an advisor should actually disclose with respect to practices related to both revenue sharing and other types of compensation arrangements. So I suggest taking a look at that. And I'll also note that in addition to the fiduciary interpretation, of course, and all of those pieces of guidance, Form ADV also requires advisors, of course, to disclose compensation structures in multiple locations, and those disclosures should align in all the different parts. So another thing to consider.
Ryan, can I add a point that I'd like to address for everyone? It's really not a conflict, but it goes hand in hand with conflicts and compensation. I think it's very important, especially for advisors that have private funds, pay specific close attention to your PPM and your LPA, and make sure your compensation and what you're charging is strictly in accordance with what you've disclosed to clients in the PPM and LPA. I see a lot of cases where advisors aren't following what they've disclosed in their LPA or their PPM, where they're charging something that they haven't disclosed, and that's where they get fouled up. And what part of that compensation is broken deal expenses, when they're doing co-investments for these private equity funds. So I think, as well as looking at the suitability issues, everyone should pay very close attention to your PPMs and LPAs with regard to compensation, because that's going to be looked at very closely by the SEC, and also investors that are doing due diligence on the investment advisor as well. Sorry for interrupting.
No, Aaron, I appreciate that. And Anna, thank you for that overview. But Aaron, to your point, I actually think that's a great segue, because the question that I had was for Colin. Is that the SEC had brought an action last year against an advisor, for amongst other things, accelerating portfolio company monitoring fees. And, I think this just goes to the point about, private funds, making sure that you're charging fees and expenses in connection that are consistent with the LPA and the PPMs. And so, Colin, can you give us a little bit of a background about the that AIM case and tell us about that?
Yeah, sure. The American infrastructure case was, as you noted, was a case from September of last year, and there were a few different issues in that case. But I think for purposes of this discussion, the interesting one is the accelerated monitoring fees. And so the advisor had an arrangement with one of the fund portfolio companies to pay a monitoring fee, and there was a provision for accelerating it in the event that there was an early termination. And that acceleration was triggered when the advisor caused the portfolio company to be sold. The advisor, there was both a duty of care and a duty of loyalty issue here. The advisor both failed to disclose its conflict as the recipient of the accelerated monitoring fees to its client, but also failed to consider whether accelerating the monitoring fees was in the client's best interest. And so, and I mentioned there were, and as you did, there were a couple of other issues with that case. There was also an issue with failing to disclose and obtain consent before transferring a portfolio asset out of the fund and causing the fund to make a loan to an affiliate that also presented other issues. But yeah, that I think was a notable and interesting case, and resulted in a $1.2 million penalty and over $440,000 in disgorgement.
Great. Yeah, and I think you had mentioned in some of our preparations that there was another case that came up in sort of the compensation arrangement scenario. And I think that was the key investment services matter.
Yeah, sure. I'd be happy to discuss that one, Ryan, as well. And I guess I would note as well that in some of the other recent enforcement matters that I was talking about, they involved conflicts of interest that were inadequately disclosed or not disclosed that related to things like fees and compensation. And so this is an issue that can crop up in a number of different areas. But key investment services is another interesting recent case. It was from May of this year. It involved a dual registrant, so there were issues both under the Advisors Act and Reg BI, and there were recommendations that clients transfer their accounts to an affiliated private bank, but there was no disclosure that the advisor reps and registered reps would be getting compensated for each of those transfers. And so it presented issues both under the Exchange Act, under Reg BI, and as well as under Section 206 of the Advisors Act. And as in many of these cases, I should note, I didn't dwell on this, but many of the cases that I've already talked about also involve the compliance rule, 20647, which I think we're going to get to later. So yeah, that's another interesting case, a recent case involving, fiduciary breaches in the area of advisor compensation.
Great. Thanks, Colin. There was a question that came in for the audience, and I just wanted to throw this out there and see if anybody had any thoughts on this. The question is, as it relates to processes for best interest determinations, economic incentives to investment advisor reps, and annual reviews, I'm curious to know how others are approaching reviewing and or addressing wrap fee accounts that may no longer be in the client's best interest due to a lack of trading in the account. Does anyone on the panel have any thoughts that they can share on this point?
I would like to share my thoughts, and this is Ryan, from my CCO experience, not from my SEC experience. I will tell you, one of the firms I was a chief compliance officer with was heavily we were mainly retail and wrap. That was our main business. And one thing I did on a semi-annual and an annually basis, I looked at every account with regard to trading to make sure that they were still, suitable for the wrap fee program. And as part of your fiduciary duty, it's my understanding as an investment advisor, that's part of your duty to always check on your client, because don't forget, clients' financial situation or their investment objectives are changing. And you're supposed to, at least, I did on a semi-annual and annual basis. I always looked at accounts. I looked at, what their restrictions were to see if there was any correspondence to change any restrictions on the account, if there was any changes to their investment objectives or strategy that that, you know, needed to be made that weren't made. And then I would look at trading. And I will tell you, there were some instances, and, you know, unfortunately, senior management wasn't that happy, but there were some instances where, you know, I said, you know, this isn't suitable for clients anymore because there's no trading going on, and we can't charge this, you know, excessive fee, and there's no trading.
I would just add to what Aaron said, Ryan, and just note that one of the cases that I had previously mentioned in the context of RAP fees, Waddell and Reed, involved a very, you know, precisely this issue, really. And so to the extent it's helpful to this audience, I would recommend that people go back and look at that order. It's from September of 2022.
Great. Thanks. I think now would be a good time to turn to our discussion on compliance programs. So let me go ahead and pass it over to Aaron and Jim if you guys want to talk a little bit about compliance programs, sort of the annual review process, you know, risking and things of that nature. So.
Yeah, and I should have started off by saying that the views and opinions that I expressed today are mine alone and not those of Sanders Capital. So. But I think we wanted to talk about, it's the 20th anniversary of Rule 20647. So we thought we'd spend a few minutes talking about the best practices surrounding your annual compliance review. I know, Aaron, you had mentioned, but you've been on both sides. You've been a CCO in the industry, and as well as being at the SEC in the enforcement area, in the exams area. So I thought maybe a good place to start was, what do you see as sort of an effective annual compliance review process when you go into firms?
Sure. Thank you, Jim. Mm-hmm. I would like to stress, and I apologize, my computer is just, I don't know what is going on with my computer, but I apologize for losing my video. I would like to start by saying that the key, the most important key to a successful annual review above all is documentation. You must document the process, because there's no way for the SEC or even institutional clients or any clients that's doing due diligence on you to be able to see that you did an effective annual review that included testing. And I'll sort of give you what I consider to be, you know, okay. I think the first thing you need to do is develop, and this could be as simple as an Excel spreadsheet, some kind of risk matrix, or even a compliance calendar where you've decided these are the risks or the issues I'm going to look at for the year, and this is what I'm going to mold my annual review around. And I think that's a really good place to start. Then I think your next step would be to decide, okay, once you have the areas that you're going to look at for that year, what's my testing going to look like? Am I going to look at trading? And so I'm going to test that daily to see what best execution looks like, what trade aggregation looks like, what are investment allocations looking like from portfolio managers. So based on the area that you're looking at, you need to determine whether you're going to test on a daily, weekly, monthly, quarterly, semi-annual, or annual basis. And I think that's your next step. After that, I think you need to develop what your testing program's going to look like, and you need to summarize, okay, here's what I'm, let's just say the SEC just came out with the risk alert with private fund expenses. So that's what you've decided that that's one area you're going to look at as part of your annual review. And so you've decided to test what your PPM and your LPA states, what you're allowed to charge and what you're allowed to expense. And now you're looking through your accounting records to make sure that everything is in line. So you pick your testing sample, you test it, and then you document your testing and you keep those records. So then you would do that for each area that you've decided that you're going to look at for that area, document it, and then what I did as a CCO, I rolled that up into my annual review, made like a couple summary paragraphs in the front end of my annual review explaining what I've looked at, included my risk matrix, included my documentation. And as part of my testing process, I would have had some areas where I found some issues and corrective action was needed to be taken. So that would also be documented as part of my testing. And this is another key element. Make sure whatever corrective action that you suggest and management agrees on is implemented. And not only ensure that it's implemented, make sure that you document what the corrective action is. And you wrap that all up into a nice package. And I think, that's the most effective annual review that you can do. That's sort of how I gauge, and that's from the SEC perspective. They're the type of things that I would look at, and look for when I came in to assess an advisor's annual review. And I will tell you, it's still common, and you wouldn't believe it. After the compliance rule and the annual review rule have been in existence this long, I actually went on a examination a couple months ago where we went into an advisor and he did not document his annual review. And he said, I did my annual review. And, myself and the other examiner were taken back because, he couldn't substantiate it. He couldn't show us, we asked him, another thing, when you do changes to your policies and procedures based on maybe results from your annual review, make sure you keep a draft that shows the changes you made resulting from your annual review. And that could be as easy as doing track changes in a WordPerfect document. So that's sort of my tips and what I look at. I don't know, Jim, if there's anything you may do differently that you'd like to maybe add.
Yeah, I want to talk about the risk matrix once more, but I actually have a question for you on the updating of the policies and procedures, because I think one thing that I think people in the industry do struggle with is they do try to keep the policies and procedures current, but is it a red flag to you when you look at a firm if the policies have been changed too much, or is that actually a good thing because it shows that people are monitoring it?
And again, these are my opinions, so I don't want to speak for everybody at the SEC,
Right.
but I look at it this way. If I go into a firm and I see an annual review and I don't see any corrective action, or I see a policies and procedures manual that let's say, Jim, was drafted in 2022, and I don't see any revisions, I'm going to be a little curious because don't forget, an investment advisory business is evergreen. It's constantly changing. Procedures changes, operations changes. You might have a new product that you're offering, so that's going to cause a change. So right. I would say I would probably be a little more skeptical if I went in and saw no corrective actions taken or, no changes to policies and procedures versus if I saw a lot of changes or a lot of things uncovered and a lot of corrective action taken. Because don't forget, that's what this is all about. As chief compliance officers, our job is to look at our business, assess risks, try to mitigate risks or, eliminate risks, protect our clients, but also, protect, and it's a double-edged sword, of course, because not only are you protecting your clients, but, your firm is in business to make money and you have to report back to management and, you have to do your part to management. So it's, right. But no, I would be more suspicious the other way, Jim, than if I saw a firm that was doing a lot of corrections or a lot of changes, and of course, if I saw that, I would look to make sure those changes are warranted and that they're in accordance with what's going on at the firm at that particular time. Right.
Just back on the risk matrix, I know there's not, as far as I know, a requirement to have a formal risk matrix, but I do think that they've gotten, you're right, it could be a piece of paper with just your major risks listed on it, but I think they have gotten much more sophisticated over time. And I know some firms, you list out your risks, each risk has a corresponding control or multiple controls. Each of those controls has a corresponding test or multiple tests. Some tests can actually be used to test various controls. So it all kind of links together. They're systematized. Your tests can then populate your compliance calendar. So you're doing ongoing risk-based testing throughout the year, not just waiting until the end of the year to do it as part of your annual compliance review. So I'm just curious if you have any more thoughts on what a proper risk matrix would look like, or what format you think is best.
Well, as I said, I can only speak for myself and some of what I've seen. Basically, again, it could be as simple as an Excel spreadsheet where you've said, okay, I've identified risk. This is an operational risk. This is a regulatory risk. This is a marketing risk, or this is a PR risk. I don't want my firm to be, featured in a news article that's in trouble with the SEC. So, I mean, I just think, they're very, I would say they are very specific. And if a risk matrix is good and thoughtful, it's going to really, be very particular to the firm that, to you and the firm that you're creating it for.
Mm-hmm. Okay. Just in the interest of time, so as part of when you're sort of doing your risk assessment and creating your risk matrix, I know one of the things that's a strongly advised practice is to look at recent enforcement actions, SEC risk alerts, and pending rules. Just to sort of segue quickly into a sort of hot topic, I know there aren't final rules around AI yet, but most of the firms I talk to are thinking about AI policies and procedures. There's a lot of different variations on that, but not to wait for the final rules to come out. There's an opportunity to be getting in front of that now. What are you seeing on the AI front, and can you give us any indication where the SEC is focused in that regard?
I will tell you, and again, I'm speaking for myself. One of the things that I've noticed is when we go in to do exams now, on the request list, there are several items that have to do with AI. We were asking, are you using AI in the investment decision-making process? Are you using AI in any of your operational issues? And then the next question is, are you investing in any firms that are, using AI or they're driven by AI? Because I think a lot of people are throwing the AI around very loosely, just to say that they're using AI or they're investing in AI, when in fact they really aren't. So I mean that's the most important thing. Be truthful and concise on what you're disclosing. If you are using AI, say it. If you're not, don't say it. And if you're investing in companies that are AI driven or focus on AI, make sure you disclose that as well. And I would say, if you are answering yes to any of those questions, make sure you have some sort of bare minimum AI policies and procedures.
Right. And a starting point for that can be just to take a moment to catalog where is AI being used in your firm and in what way, right? And maybe even divide it into two categories. Yeah. Where are you pulling things out of a large language model, and how are you using those? And that opens up questions of how you test the accuracy and validity and all of that. And also, where are you putting things into a large language model, your own firm data, and how do you ensure confidentiality and data protection, and is there client information in there? That's at least just a very simple framework to start from with.
Yeah, correct.
So Ryan, I don't know, do we want to just spend 5 minutes? I don't know if we need time for questions.
Well, I think before we jump into any questions, I did want to reach back out to Colin and ask him what enforcement may be seen in the space of sort of compliance programs or issues. I think you had mentioned before that there was a case. Was this the Jordan Zelzenak case, or?
Yeah, I'd be happy to talk about that one. And as I noted earlier, many of the cases that I've already mentioned, in addition to involving substantive charges under 206 with respect to violations of fiduciary duty, involved related 206-47 charges because firms either didn't have appropriate compliance programs that were tailored to their risks, or they had them and they weren't doing the things that the policy said. But Jordan Zelaznik Advisors is a case from just recently, from September of this year, that involved a failure to implement key aspects of a compliance program with respect to relying advisors in their personnel. So specifically, they weren't implementing what was in their program with respect to conducting compliance training for all supervised persons, spot checks of books and records that they were required to maintain, and periodic physical inspections of the relying advisors. And so that resulted in a charge under the compliance rule 20647, and a $150,000 penalty. But the 20647 is a charge that frequently shows up in our enforcement actions.
Thanks. I think we have just a couple minutes left, and so this time I just wanted to take a look. I think we had a couple audience questions. One is, are we expecting any changes in light of the election results? I'm not sure there's much we can really say on that one. You know, we don't really know what the policy priorities were going to be of the incoming administration. So I don't know if there's much more we could say on that. But there was another question. What is the SEC's recommended documentation for advisors' compensation arrangements and financial incentives? Does anybody have any thoughts on this one? Or?
Yeah, can you hear me? Okay,
yeah,
great.
Yeah,
yeah, I just very quickly, I just think advisors should think about documenting comp arrangements and financial incentives consistent with how they document and track other conflicts of interest, which hopefully they are also documenting, because the staff, of course, takes the view that firms should consider documenting the measures it takes to address and monitor all the conflicts of interest in order to demonstrate compliance with applicable standards of conduct. And in terms of how to go about doing that, you know, there are lots of different approaches. You know, we're aware of advisors taking different routes, such as conflicts inventories, and, you know, generally think that these conflicts should be treated consistent with those internal approaches.
Great. In the last minute that we have, I just wanted to reach out to the rest of the panelists and see, is there anything else that you would like to add to the panel before we conclude?
I just think, you know, for every CCO that's out there, I think one of the most important things to remember is no matter what you do your best you can with it and always document. I think that's very, very important, because that's the only way anybody can tell what you've done, you know, is if you document it.
Great. Thanks, Aaron. So Anna, Colin, Jim, Aaron, thank you so much for your time and sharing your thoughts and experiences with this crowd. You know, for the rest of the audience, please stay tuned for the upcoming Hot Topics panel. Thank you so much.
Thank you.
Thank you. Bye.
Thank you.
Welcome back. I'd like to announce our last panel before our closing remarks, our panel 6 Hot Topics lightning round. Thank you first to our last panelists and Brian for keeping the lively discussion with regards to registered investment advisor concerns and topics, and it was timely information, especially given our recent release of our priorities. So next, we have a panel that covers several topics of interest, and this is a rapid fire type panel where we will try to cover many issues and current topics that may be of interest to you. Totally appropriate as we approach and are in our latter half of our agenda-packed day, because this is an all-star panel that promises to keep you awake, certainly till the end of the day here. The moderator for this panel is Mr. Stephen Levine, who is our Senior Special Counsel located in our Chicago Regional Office. Stephen, I will turn the discussion over to you.
Thank you so much, Vanessa, and welcome to the audience who have lasted this long. Congratulations. We have a great set of hot topics to share with you on this last panel. The topics, which are listed in your agenda, include artificial intelligence, the Internet Advisor exemption from SEC registration, crypto assets, new examination developments in that space, T+1 settlement cycle as it relates to IAs, IA growth through merger and acquisition and issues related to that, pre-IPO offerings, and lastly, the new FinCEN advisor AML rule. I am privileged to introduce our distinguished set of panelists from exams, enforcement, and IM to share some observations, priorities, and guidance from their respective divisions about these important topics. From the Division of Examinations is Maura Keating, Associate Regional Director for the New York Regional Office's IAIC Examination Program, Lindsay Topolowski, Regulatory Counsel in the National Exam Program Office, Roberto Grasso, Branch Chief in the Division of Examinations, Office of Risk and Strategy, Branch of Surveillance and Reporting, Nadia Brannan, Branch Chief of Crypto Asset Specialized Exams in the Technology Controls Program. From Enforcement, we have Virginia Rosada Desalet, Assistant Director. And from the Division of Investment Management, we have Sirimal Mukherjee, Senior Special Counsel, and Matt Cook, a Senior Counsel. We have received some questions in advance of the panel that we were able to incorporate into our discussion. Due to the time constraints and/or sensitivity, there were a few we're not going to be able to get to. We've got around an hour to get through all the important topics, so let's get to it. First topic is artificial intelligence, and it concerns regulatory issues surrounding the use of artificial intelligence by SEC-registered entities. Offering perspectives from exams, enforcement, and IM are Rob, Virginia, and Sirimal. Let's kick it off with exams. Rob, I noticed that AI was included in the Division of Examinations 2025 exam priorities memo published just a few weeks ago. What has the Division of Examinations been up to in this IA space?
Hi, Stephen. Thanks. It's been a really big year for AI-focused examinations. Some of the exams have resulted in a number of high-profile settlements. We find that artificial intelligence only continues to be rapidly implemented as the industry and technology develops more applications for a wider range of uses at securities firms. So AI continues to be more developed by firms as they become more familiar with the technology and they start to explore where it could be used for a variety of uses, including investment research, communications with clients, marketing, along with internal applications like in compliance and surveillance. So AI continues to be an exam priority for the division, where examiners will be continuing to conduct a range of examinations that have an AI focus, addressing various particular uses of the technology they're registering.
Okay. What are some of the key regulatory issues that firms should be focusing on when it comes to AI?
Sure. I think there are a few main areas based on our observations. I'd recommend first and foremost that firms spend some time developing their written compliance procedures to reflect their internal controls around AI systems. In many of the exams, we found that many firms fail to develop any written policies and procedures around the supervision of their AI systems. So I think it's important to think about how, when developing the written procedures, how the firm's supervisors from compliance, their technology staff, and portfolio managers will supervise these systems, whether they're developed internally or they develop them internally or they use third-party contractors. Another big issue is around disclosure. It's important to make sure that your disclosures, like your Form ADV disclosures, for example, reflect how the firm is really using artificial intelligence accurately. So it's the existence of its use, but also to make sure that the firm isn't exaggerating the firm's level of implementation or its performance of those systems. Some smaller firms are starting to use outside contractors and platforms from various tech companies for either investment research, trading, or compliance functions. So it's pretty important to have a well-documented due diligence system in place before bringing on board any third-party developed systems or platforms. Along with the usual issues of data privacy and compliance that we talk about, it's important that firms understand how these third-party systems operate or use data, and how information is being implemented, and what are the actual controls around it.
That's a good list. Are there any particular regulatory issues or problems in the use of AI that you've observed recently?
Again, going back to disclosure, we see a lot of the use of boilerplate AI language with a lot of hedging terms in it to minimize the disclosure about their use of AI or the data used by the AI systems, or sometimes the outcomes produced by the systems. During a number of exams, when we look at AI systems, we review this disclosure language to make sure that firms aren't disclaiming away their fiduciary obligations related to AI, and that to make sure that the disclosures accurately reflect their actual use of AI. Firms should be cautious when using any kind of disclaimer language or hedging language in their ADV brochures or even client agreements. It's crucial that the language is really accurate and it truly represents their current use of AI in order to maintain their transparency to clients and maintain their fiduciary duty.
Thanks, Rob. I want to switch over now to enforcement. Jen, can you tell us what the Division of Enforcement has done in the area of AI? And more importantly, what enforcement may be focusing on in the future?
Sure, I'll start with what we've done so far, and you'll hear a lot of the same themes that Rob just went over. So far the focus on AI and enforcement has been AI washing, which is basically the same type of disclosure cases that we've always brought. So for example, in a case against Delphia claimed that it was using AI and machine learning to inform its investment recommendations, and that it was analyzing customer information like social media accounts and online purchases. And then in a case against Global Predictions, we found that they claimed to be the first regulated AI financial advisor, and that its technology incorporated, quote, expert AI-driven forecasts. And unfortunately, none of that was true. So while these are the first AI washing cases, we can see some pretty clear parallels with prior robo-advisor cases like Betterment, algorithmic trading cases like Citadel, pretty obvious similarities with some of our ESG disclosure cases like DWS, Bank of New York Mellon. And the main theme across all of these cases is say what you do and do what you say. So historically, we've seen firms trying to capitalize on investor interest in new products by making all sorts of claims, but those claims don't always match reality. Advisors need to make sure that whatever they're saying about their AI capabilities is accurate.
Okay, apart from AI washing, what are some of the other potentially problematic areas where firms might land themselves into trouble with enforcement?
Okay, so I want to start by saying we are technology neutral. So we recognize that AI has great promise and also great risk. We're focused on making sure that firms are doing what they need to do to protect investors from and warn investors about the risks. We expect to apply the same securities laws we've always enforced in the same ways to this new technology. So how might that come up? Obviously, the use of AI for fraud or market manipulation would be a violation of the securities laws. But beyond that, investment advisors in particular need to ensure that their use of AI is consistent with their fiduciary duties to clients. So for example, advisors have a duty of full and fair disclosure. Advisors need to ensure that they really understand how their AI model works and how it's being used so they can accurately represent risks and performance. Beyond that, investment advisors also have a duty of loyalty. So regardless of technology, firms must ensure that they are not placing their own interests ahead of their clients' interests. This might mean incorporating specific programming to avoid conflicts. At the very least, it means understanding how their technology works, including whether there are any conflicts inherent in the programming and how it will respond when a conflict arises, and then taking steps to fully and fairly disclose the conflict and, wherever possible, to avoid or mitigate the conflict appropriately. Advisors also have a duty of care. They're responsible for providing advice that is in the client's best interests and for monitoring the client's investments and the ongoing suitability of those investments over the course of the relationship. So that means not only considering whether this AI model is appropriate for each specific client, but also whether it's working properly and whether it continues to make appropriate investment choices over time. It's also important to understand the limitations of the AI model and to put controls in place to address those limitations. Advisors also have compliance and record-keeping responsibilities. So they should consider, do they have policies and procedures in place regarding the use and review of AI? Are they updating these policies and procedures periodically, particularly given changes in the technology or modifications to the firm's system? Are firms keeping up with their record-keeping responsibilities, for example, under Reg BI when they're relying on AI? And last, data privacy. Are there adequate safeguards concerning client data, material non-public information, and other confidential information? For example, if one part of your firm has access to material non-public information and another is actively trading and using AI, are there appropriate protections in place to safeguard the AI from accessing the material non-public information? So I don't know what our next AI case will look like, but hopefully that gives you some ideas on how to avoid being the next AI enforcement headline.
Thank you, Jane. I want to turn it over now to IM and Siramal. So, Siramal, what's cooking in the area of rulemaking around AI? Whoops.
AI. Thanks, Stephen. As most compliance professionals know, last year the Commission proposed a rule. The proposed rules would apply when a broker-dealer or a registered investment advisor uses or reasonably foreseeably may use covered technology in an investor interaction. They would require a firm to evaluate its use of certain technologies in certain investor interactions to identify and subsequently determine whether any conflicts of interest that do exist place the firm's interests ahead of investors' interests. If so, firms would be required to eliminate or neutralize the effect of the conflicts. The proposed rules would also require related policies and procedures and record-keeping requirements. As folks probably are aware, the Commission received a lot of comments expressing a wide range of views. Right now, the staff is still reviewing those comments.
Okay, in the absence of the predictive data analytics rule being in effect at this time, what should compliance professionals be thinking about in the area of digital engagement and predictive analytics as marketing tools?
Sure. On the advisor side, firms are subject to the marketing rule, as well as general anti-fraud principles. As Virginia noted, advisors are also subject to a fiduciary obligation. These obligations apply in the context of firms' use of digital engagement practices and predictive data analytics. Just to highlight some of the obligations, under the fiduciary duty, an advisor must provide investment advice that is in the best interest of its clients based on the client's objectives. Eliminate or make full and fair disclosure of all conflicts of interest which might incline the advisor to render advice which is not disinterested, such that a client can provide informed consent to the conflict. This means that generally advisors would either eliminate the conflict or adequately mitigate the conflict such that full and fair disclosure and informed consent would be possible. While full and fair disclosure of all material facts relating to the advisory relationship or of conflicts of interest and a client's informed consent prevent the presence of these material facts or conflicts themselves from violating the fiduciary duty, such disclosure and consent do not themselves satisfy the advisor's duty to act ultimately in the client's best interest. On the broker-dealer side, broker-dealers are subject to existing obligations under the federal securities laws and SRO rules that apply generally, including with respect to a broker-dealer's current use of AI or predictive data analytics. For example, to the extent that the broker-dealer makes a recommendation, as that term is interpreted by the Commission under Reg BI, to a retail customer through or in connection with AI or predictive data analytics, Reg BI would apply to the recommendation. Under Reg BI and its attendant obligations, broker-dealers and their associated persons are required to act in the best interest of a retail customer, without placing the financial or other interests of the broker-dealer or its associated persons ahead of retail customers' interests. Under the anti-fraud provisions of the federal securities laws and SR rules, broker-dealers have a duty to deal fairly with their customers and observe high standards of commercial honor and just and equitable principles of trade. FINRA rules also govern broker-dealer communications with the public, requiring them to be fair and balanced. Compliance professionals ultimately should be mindful of these and other existing obligations that can apply to an advisor or broker-dealer's current use of AI or predictive data analytics.
Thank you, Sirimal. Rob, I'm going to give you the last word on this topic. Do you have any final advice for our compliance professionals who are here today on the use of AI by advisors?
Sorry about that. Sure, Stephen. I would say that the securities industry is rapidly exploring new AI applications. The technology, new products are developed and introduced. And so we're right now at a point where firms are in the testing phase, testing new innovative solutions and assessing how AI can enhance their operations or increase efficiency. And whether that's an internally developed AI system or using third parties or some combination of both, every day we find new ideas for new products or services or new systems where AI technology can improve the existing processes or create entirely new services. So eventually, I think we're going to see the integration of AI into most aspects of technology used in the securities industry. It could be in more obvious ways that we see, or even less obvious, subtle ways in systems that operate in the background. As the technology becomes more prevalent in the securities industry, I think everyone should try to expand their understanding of the technology so that they can remain aware of what are the risks and also how to leverage its benefits.
Great advice, Rob. We're going to turn now to topic 2, which is the 2024 amendments to the Internet Advisor Exemption Rule. Sirimal and Nadia will be stepping up to the plate on this one. Sirimal, can you give us a brief overview of the highlights of this rule that compliance professionals should be focusing some attention on?
Sure. In March of this year, the SEC adopted amendments to modernize the rule that exempts Internet investment advisors from the prohibition on SEC registration for smaller investment advisors. The effective date for the amended rule was July 8th, 2024. The compliance date for the amended rule is March 31st, 2025. Advisors no longer eligible to rely on the rule must register in one or more states and withdraw its registration with the Commission by June 29th in 2025. The final amendments are designed to modernize the exemption to reflect the broader evolution in technology and the marketplace since the rule's adoption in 2002, and to better align current practices in the investment advisor industry with a narrow exemption for certain investment advisors that did not fall neatly within the framework established by Congress. So what did the rule do? 3 primary things. They require an investment advisor relying on the exemption to, at all times, have an operational interactive website through which the advisor provides investment advisory services on an ongoing basis to more than one client. They eliminate the current rule's de minimis exception for non-internet clients, thus requiring an internet investment advisor to provide advice to all of its clients exclusively through an operational interactive website. Finally, they amend Form ADV to require an advisor relying on the exemption as a basis for registration to represent on Schedule D of its Form ADV that, among other things, it has an operational interactive website.
What prompted these amendments, Firmo?
Sure. As I mentioned, they were prompted by a desire to reflect the broader evolution in technology in the marketplace since the rule's adoption. And they were also, the staff has observed that advisors who were relying on the rule were relying on the rule without meeting the rule's conditions.
Is there anything in particular that you would like to have compliance professionals be focusing attention on concerning this new rule that they may not know that they should be focusing attention on?
Sure, I think two definitions warrant close attention. The first being the definition of digital investment advisory service, which is defined to mean investment advice to clients that is generated by the operational interactive website's software-based models, algorithms, or applications based on personal information each client supplies through the operational interactive website. The second definition, operational interactive website, is defined as a website, mobile application, or similar digital platform through which the investment advisor provides digital investment advisory services on an ongoing basis to more than one client, except during temporary technological outages of administration.
So how are these definitions important, and where might firms go awry?
As with all rules, the definitions carry the weight here. I think firms should focus on how, through the definition, firm websites must be operational in order to rely on the rule. And this means, in part, that advisory services must be provided to more than one client.
Thanks, Firmo. Turning to exams now, and Nadia. Nadia, as you know, rulemaking often occurs as a result of exam observations. What issues had exams been observing in its examinations of internet advisors?
Sure. As Firmo mentioned, we have been seeing a rush to register. As we were contemplating a series of exams of robo-advisors, literally a quarter of those have deregistered before we got to them. And then the other half of those that we examined did not have a working platform or any client assets to manage. And those that did often had half-baked product. They were startups with limited resources, integrating open source software with rather poor development and cybersecurity practices. They had quite poor, if at all, compliance programs, which obviously presents a huge risk for retail clients. We also saw advisors touting their SEC registration, often using it as means for securing additional funding and making themselves more attractive to potential clients.
How does the new rule address these issues?
Oh, it does it right straight head on. Unless you have an operational interactive website or app, you cannot register as Internet Advisor.
Do you have any practical advice for firms seeking to enter this space from the registration perspective?
Sure. As you are developing the platform, consult with the competent counsel. Have them assess if you meet the requirements of Rule 203A 2E. Does your platform look like a broker-dealer? Do your clients choose themselves what assets to buy or sell? Think about whether your platform have a potential to operate as an unregistered investment company. Do your clients have an ability to reasonably customize their portfolio? Are you offering de facto a pooled vehicle? Are you planning to comply with non-exclusive, and think about how you will comply with the non-exclusive safe harbor Rule 3A4 of the Investment Company Act?
Thanks, Nadia. Broadening out the discussion beyond registration issues, what are some of the other exam observations concerning Internet advisors that compliance professionals should be focusing some attention on?
Well, here's a laundry list of issues that we see in exams. Number one, suitability. Advisors do not collect sufficient information to assess clients' investment profile And even when the questionnaire logic determines that certain investments are not suitable for a client, they will still not turn down the client and let them have access to the platform. Custody. We have seen advisors that have ability to programmatically, via API application programming interface, transfer assets from one client to another between client accounts, or initiate client withdrawals. In the arena of performance advertising, we observed lack of performance history. These are new registrants quite often. We've also seen them mixing back-tested data with actual. Gamification, another area. I've seen advisors combining fantasy finance and similar-looking advisory platforms, as well as educational platforms that were offering children an ability to make crypto investments, though minor ones, with quantitative limitations. And as already has been mentioned, quite a bit of AI washing. For those advisors who offered crypto assets, we've seen inadequate disclosures related to custodial limitations, as well as lack of insurance coverage, and also use of non-US based platforms. Thank you.
That's a nice list, Nadia. I'm going to keep you on the hot seat for our next hot topic, crypto assets. And a quick note and qualification to our audience. Our focus for this topic will be exclusively on exams. I understand, Nadia, that the Exams Technology Controls Program, TCP, has recently stood up a new branch dedicated to crypto. Can you tell us a little bit about it?
Yes, Crypto Asset Specialized Examinations, or CASE for short, is a new branch that was created within Technology Controls Program at the beginning of 2024 fiscal year. The purpose of the branch is to conduct complex examinations of registrants that offer crypto assets to their customers, and also to provide technical support for other examination teams that encounter challenging crypto asset related issues.
And what's going on in the crypto space for exams?
Big question. So the last few years have seen a lot of changes in crypto arena. However, I'm not going to be talking about pending litigation matters. There were two events of note for us in examination specifically. So one is approval of Bitcoin spot ETPs in January of this year, followed by Ether ETPs in July. And the second one is approval by FINRA of two special purpose broker dealers, one Prometheum, another one is T0. So these Bitcoin spot ETPs are cash settled 1933 Act ETPs, so they're not registered investment companies. There are so far 11 of them, and then many of the same entities that launched Bitcoin ETPs also launched 8 Ethereum ETPs in July. So where are those now? The total daily volume for Bitcoin ETPs are, as of November 1st, are 3 billion a day versus 281 million for Ether. The net assets under management for Bitcoin ETPs is a little bit north of 70 billion with B, which is about 5% of total Bitcoin market cap. And then 7 billion, or about 2.25% of underlying Ether market cap. And their average daily inflows are about 32 million. Steve?
Has the exam program started looking into these new developments and how firms are managing and dealing with these particular new new products?
Yes, we have started in spring of this year to look into several authorized participants and market makers to assess their operations, market dynamics, and key risks associated with these products. We are also continuing to conduct examinations of registered investment advisors in connection with these crypto spot ETPs, specifically focusing on such areas as custody and trading of underlying crypto assets.
And more generally, what are some of the other issues in the crypto space that the exam program is focused on?
Yeah, crypto assets remain one of the priorities for the examination program. In the past fiscal year, we examined a number of advisors that offer crypto assets, including registered investment advisors. And we have continued to focus on some of the key crypto-specific areas, and those are custody and cybersecurity, suitability, counterparty risk management, particularly in light of not so recent failures in crypto space, marketing and disclosures, and also unregistered affiliates. Steve?
What are some of the division's plans for examinations for the next year in the crypto space, in addition to what you've already talked about?
Yeah, thank you. We will continue to monitor and, when appropriate, examine registrants that offer crypto assets, specifically to assess if they meet their respective standards of conduct when recommending crypto products. And those have been mentioned in the prior sessions, with a particular focus on initial and ongoing understanding of the underlying products, especially if they are offered to retail-based customers, including older investments, and also investments that involve retirement assets. And so number two is also to see whether these advisors or registrants regularly review, update, and enhance their compliance policies and procedures. And again, specifically policies and procedures around custody practices, risk disclosures, BSA compliance reviews, valuation procedures, as well as operational resilience practices, including data integrity and business continuity plans. That's what I have. Thank you.
Is that it?
For now.
Okay. Next topic is T+1 for investment advisors. Most folks are focused on this rule as a BD rule, but we want to make sure that the IAs are paying attention too. And Lindsay will be speaking about this topic. Lindsay, can you provide us with an overview of the T+1 settlement rule as it applies to IAs?
Thanks for the question, Stephen. Good afternoon, everyone. So as most of you probably know, in February 2023, the Commission adopted a series of new rules and rule amendments to shorten the settlement cycle for U.S. broker-dealer transactions and securities. And the compliance date for those final rules and amendments was May 28, 2024. It's important to note that the rulemaking impacts registered broker-dealers and registered investment advisors in different but some related ways. So in order to understand the advisor obligations that I'm going to speak to today, you must understand some of the new broker-dealer obligations. So first off, we have the amended Exchange Act Rule 15C6-1. This is the amendment that reduced the length of the standard settlement cycle for most U.S. broker-dealer transactions from 2 business days after trade date, T2, to 1 business day after trade date, T1. In addition, and as a way to improve institutional trade processing, the Commission also adopted a new Exchange Act Rule 15C6-2. This new rule requires broker-dealers engaging in certain transactions with other parties, including investment advisors, to have written agreements or written procedures that are reasonably designed to ensure the completion of the allocation, confirmation, or affirmation of those transactions, the ACA process, as soon as practicable and no later than the end of day on trade date. So what does this mean for advisors? It is in connection with these new requirements that the Commission also amended the Advisors Act Books and Records Rule 2042. It now requires advisors to make and keep true, accurate, and current records with respect to those transactions eligible for that ACA process and therefore subject to new Rule 15C6-2. So what are the records? The advisor records are copies of each confirmation they receive, any allocation, and each affirmation they send or receive. The allocation and affirmation records must have a date and timestamp showing when they were sent or received. Now, these record-keeping requirements apply without regard to when the records were sent or received by the advisor. So, for example, if an advisor receives an affirmation on trade date or a copy of that affirmation on T2 from their custodian who affirmed the trade, they must retain both of them. One more thing worth noting on these rules that advisors should understand that while the record keeping is the only rule obligation specific to them, they ought to anticipate and prepare for any operational changes necessary to enable brokers and other market participants to comply with their own obligations under these rules and amendments. So, for example, since broker-dealers must get that ACA process completed on trade date, advisors may see more proactive efforts by their executing firm to get this information from the advisor earlier in the day.
Thanks, Lindsay. And what is the Division of Examinations doing in the area of T+1 compliance as it relates to investment advisors?
Sure. So as noted in our recently published 2025 examination priorities, the division is evaluating advisors' compliance with the amended books and records requirement associated with T1. So during our exams, you can expect that the staff will request and review records related to the advisor's participation in trades eligible for the ACA process and subject to 15C6-2. So we will also want to understand how advisors prepared for these changes, the impact on the compliance program, and how they continue to address challenges, if any.
Do you have any observations to share yet?
Sure. So far, with limited exceptions, it does appear to staff that advisors were prepared for the record-keeping obligations associated with the transition to T1. So they were aware of the rulemaking, engaged frequently with industry groups and their broker and custodian counterparties, and have made and kept records that included the required date and timestamps.
Good to hear. What's next for exams in this area, and how can advisors learn more about T+1 and how to comply with the T+1 requirements for investment advisors?
Sure. So we're going to continue to conduct and complete these exams, and we encourage all of our registrants to review the resources available on sec.gov. So we've got a Division of Exams Risk Alert from March 2024. You can check out the proposed and final rule release and the related fact sheet. There's a small entity compliance guide. And finally, there's a shortening the settlements, securities transaction settlement cycle FAQ. So thank you, and back to you, Stephen.
Great. Topic number 5. Our next hot topic is compliance issues arising in connection with IA merger and acquisition activities. Maura is going to be taking the lead for this discussion. Maura, as you know, we are seeing in our exams and in the media following industry trends that there is a substantial amount of merger and acquisition activity in the RIA space. A report that I saw just this week reported 232 RIA M&A transactions for the first 10 months of 2024. What are some of the compliance concerns that we have been observing in exams in connection with this activity?
Thanks, Stephen. The RIA space is, of course, very diverse, so the M&A configurations are diverse as well. Some of the transactions may be opportunistic, such as a larger firm acquiring a sub-advisor or a larger firm that wants to sell off a portion of its business that it feels is no longer competitive or adds value to the business. But it also may be part of a larger strategic effort. And of course, many times a transaction is intended primarily to acquire the target's AUM or advisor field force. Because of this diversity, the firm should not apply cookie-cutter approaches to investment advisory firms' compliance with federal securities laws. Each firm's risk characteristics and compliance support should be carefully evaluated as part of the due diligence in the transaction as well as the implementation phase. Culture clashes may be inevitable, but any area for clashes should be identified early on. We are all too aware of how the impact of a firm's culture can help or hurt the merged entity. For example, If a firm with a collaborative culture towards developing investment recommendations merges with one that is more of a competitive atmosphere, it's not likely to be a successful merger. But some firms assume sometimes that these details can be ironed out, and maybe they don't always give it the attention it deserves. Likewise, the impact of technology migration and new systems versus legacy systems should really be carefully considered prior to the transaction. You mentioned the news reports that have been coming out. We've seen a lot lately, and recent news reports have focused on the rise of acquisitions by private equity firms and observations that the lowering of interest rates could lead to increase in this activity by the consolidators of smaller RIAs who acquire groups of smaller firms, and these firms are backed by private equity in their acquisitions. So we do anticipate seeing a lot more activity in this sector of RIA or M&A.
Can you drill down into some of the specific areas that could be of concern to a CCO or that we may be looking at in our exams?
Yes, thank you. Specifically, some areas to look at. Disclosures. What disclosures were made to clients of the acquired firm that could prove problematic for the acquirer to agree to? If clients went to the firm because it advertised a one-on-one advisory program, but the acquirer has a team approach, that could lead to dissatisfied clients that are not receiving the services that they were promised. Much of this should be identified up front as a possible culture clash, as I mentioned before, but it's not just a business risk. This could be a compliance risk. Policies and procedures. Will the merged firm have policies and procedures adequate to deal with merger issues identified, such as legacy clients and legacy systems? Client agreements, another big area to pay a lot of attention to. Was the acquired firm in the habit of customizing client agreements, such as fee rates? Will these terms be honored by the new firm? Will any new terms be highlighted to the clients, and can they negotiate with the new firm? Will the new firm have systems in place to track and apply any customized contract terms, such as negotiated fee rates? Protection of customer info. In an acquisition, a lot of people are involved for a lot of different reasons. The firms need to have heightened attention to protecting customers' personal information before, during, and after the transaction. Record keeping. Will the merged firm use the new company systems, retain its current systems, or employ a combination of both? In addition, CCOs should make sure that they can still access all required books and records, as well as databases with critical compliance systems, such as transaction monitoring programs. Pay special attention to facilities that the original firm relied on that the new firm may not be renewing the vendor contracts for. And of course, financial advisor departures. The firm has to expect that some FAs and or their clients may not want to go with the acquiring firm and may leave. What are the expectations regarding these financial advisors, and how will their client accounts be handled? And finally, handling of the transition itself. Clear and continuous communications to clients as to what to expect would really be ideal. RIA agreements, of course, cannot be block transferred, so each client must agree to move their account individually. This process must be transparent and monitored. CCOs might want to keep a record book of all client communications.
That's a great list, Maura. Thank you. Before and during the M&A negotiations, what are some areas what areas could, a CCO or a risk manager review in order to proactively prevent or detect possible concerns?
Well, Stephen, early and active CCO involvement will assist with identifying and managing the compliance risk. Examine the economics of the deal. Where are the cost savings, and are your compliance processes impacted? Likewise, take a look at what business assets are being brought on and what compliance risks and rewards could they bring. Now, Stephen, I know that Chicago also has seen a lot of these issues in exams. Anything to add to these observations?
Sure. In addition to your very hefty list, we have a few additional areas that we have focused some attention on, and where compliance professionals should be thinking about when actively seeking to acquire another firm or even a single IAR or RR's business. And this is kind of in the pre-acquisition leading up to the M&A. First area is due diligence. An acquiring IA should have a thoughtful and documented due diligence process. The firm should be fully aware of the investment strategy, investments employed, type of clients, custodial and brokerage arrangements, types of advisory services provided, and marketing efforts, etc. Also, the acquiring IA should have a clear understanding of any disciplinary history. Supervision, another area where attention should be focused. An acquiring IA should have a sound plan to deal with the increased and possibly differing supervision of the acquired IAR's branch offices, particularly those with disciplinary histories or unfamiliar advisory services or different investments. Where practicable, there should be a single harmonized system of supervision throughout the firm. Another area of focus is integrated compliance. Acquiring IAs should ensure they have adequate compliance policies and procedures regarding IARs and their branch offices, among other things. IAs should pay special attention to acquired IARs and branch offices that are permitted to develop and publish their own marketing materials, draft or amend advisory agreements, create and maintain their own records. In short, the more independent the entity or the individuals that you are acquiring, the more compliance oversight and pre-thought may be required. Lastly, sub-advisors and other service providers. Pay attention to them. Acquiring IAs should also engage their sub-advisors or other pertinent service providers of the acquired entities, solicitors, endorsers, trading and account record management, custodians, etc., to make sure there's consistency and to make sure that you, as the acquiring entity, are comfortable. These are some of the areas that we focus attention on, in addition to the many that you've already addressed. Okay, Maura, back to you. Any final words of advice on this topic?
Well, I would stress to CCOs, have an organized approach to the transaction. Some CCOs prepare a risk matrix of the transaction and other checklists and keep clear documentation of the risk analysis and the mitigation of each documented factor, such as confirmation of the firm that the firm's respective technology can sync, or documenting review of client agreements. That way, a CCO will have something to revert to in the event of regulatory inquiries down the road.
Thank you so much, Maura. We're going to move to our topic number 6. The next hot topic concerns some enforcement activity in the areas of pre-IPO offerings that we wanted to bring to the attention of compliance professionals in the IA space. Jen, for enforcement, is up on this one. Jen, can you tell us about pre-IPO offerings and what compliance officers should be looking out for in this area?
Sure, Steve. So the cases we've brought in this area have been in the BD space rather than the advisor space. It's mostly been sort of boiler room scenarios by unregistered broker-dealers or even barred BDs who are selling interests in pre-IPO companies, typically with a claim to charge no markup while charging significant markup. So this is not, I think, the kind of situation that anybody is going to fall into accidentally. But you can imagine a more subtle variation than the cases that we've brought so far. So I would say some things that advisors could keep in mind in the pre-IPO situation. If an advisor or its affiliate is selling pre-IPO shares, are they adequately disclosing any conflict of interest? Is it clear what the advisor or its affiliate's role is, who the client is, and who is paying for the services? Are they disclosing any markups or fees? Are the disclosures about the status of the companies clear and accurate? So do investors know what they're buying into? So while the cases we've brought so far in this space have been really fraud cases, you can imagine a case where even in the absence of intentional misconduct, there may still be a breach of fiduciary duty. So as in all areas, it's important for advisors to uphold their fiduciary duties to their clients.
Thanks, Jen. And this is kind of a public service announcement to the IA space. And so I'm going to add one more as a public service announcement. Sometimes in the course of our exams, we have been encountering firms that are packaging together large groups of retail clients into funds. And they are packaging those funds together in a manner in which they might, if those funds are deemed to be integrated, exceed the 100 beneficial owner limitation of Investment Company Act 3C1 and may actually obligate those entities to be registered as investment companies rather under the safe harbor of 3C1, of the exemption of 3C1. I would encourage firms that are engaged in, on the fund side, of packaging together groups of retail side investors into pre-IPO acquisitions to think hard about the possibility that you may end up either intentionally or unwittingly blowing past the 100-person limitation. That's all we got on this one. And we got one more topic. Our last topic is the new rule that's bringing IAs under the ambit of the Bank Secrecy Act and its AML requirements. We're going to stick with Jen, and we're going to add in IAM's Matt Cook to talk about this one. By way of background, for those of you who are not aware, on August 28th, FinCEN issued final rules to impose new anti-money laundering obligations on certain investment advisors, including an obligation to establish an AML program. The compliance date for these rules is January 1, 2026, but we think everyone should be getting ahead of the curve on this, which is why we've included this as a hot topic. Matt, what's the main purpose and effect of this new rule?
Thank you, Steve. These final rules aim to address and prevent money laundering, terrorist financing, and other illicit finance activity through the investment advisor industry. In February of this year, Treasury published a risk assessment that identifies and describes the types of risks that the investment advisor industry might face. And so in part, the rule is designed to address some of those risks as identified. But in essence, these final rules impose on investment advisors the AML requirements that have applied for many years to other financial institutions, including banks, broker-dealers, and mutual funds.
It's a FinCEN rule, but did the SEC staff have any role at all in this rulemaking?
Yes, SEC staff did assist FinCEN on the rulemaking, providing comments and other technical assistance. And then in addition, as part of the final rule, FinCEN delegated to the SEC examination authority over the new rules.
First question on everyone's mind who hasn't thought about this rule is, who's subject to the new rule?
The new rule adds the defined term investment advisor to the list of financial institutions covered by the Bank Secrecy Act. And investment advisor for these purposes is defined to include most SEC registered investment advisors, or RIAs, and all advisors that report to the SEC as exempt reporting advisors, or ERAs.
What types of registered investment advisors are excluded from the list of financial institutions?
The big one is state registered advisors. So investment advisors registered with a state securities regulator are not covered by this rule. This rule looks to advisors that are either registered with the SEC or reporting as ERAs to the SEC. And then within the category of SEC registered advisors, there are some exclusions. The rules will not apply to, for example, mid-size advisors or those who have assets under management of between $25 and $100 million. It will not apply to pension consultants, and will not apply to multi-state advisors that are allowed to and do register with the SEC because they would otherwise need to register in 15 or more states. And then finally, there's an exclusion for advisors who report zero regulatory assets under management on their Form 80B. But like I said, those carve-outs are all RIAs, ERAs. All ERAs are included in the definition.
And I think that's important to note because I think some ERAs may be caught off guard by that. How do the final rules address foreign investment advisors or non-U.S. investment advisors?
Yep. This was a hot topic during the comment review period between proposal and adoption. Investment advisors with a principal office and place of business outside of the United States are subject to these final rules only with respect to their advisory activities with a U.S. nexus. And what I would recommend is that advisors who have essentially non-U.S. advisors review closely the text of the new rules and the adopting release that FinCEN issued, which in both cases explain in greater detail when such a U.S. nexus might exist.
Okay. Turning to the requirements of the final rules. As an overview, what do the final rules require?
Thanks. As an overview, there are 5 big obligations. The first is to implement a written AML program. The second is various reporting obligations, including reports about transactions in currency and reports of suspicious transactions. Third, there are record making and maintaining obligations, including as required to comply with FinCEN's record keeping and travel rules. Fourth, there's a section talking about special information sharing procedures. And finally, there's a section describing special standards of diligence and special measures addressing correspondent accounts for foreign financial institutions and addressing private banking accounts. I should note, though, in all of this, that the final rules do provide exclusions with respect to certain activities, services, and clients of advisors. And again, the adopting release and the regulation text provide more detail on that. So I would encourage the audience to review those documents.
At a high level, what should the written AML program for IA subject to the rule include?
Yep. Each written program must meet certain requirements. There are 5 of these requirements. First, the program must establish and implement internal policies, procedures, and controls reasonably designed to prevent the advisor from being used for illicit finance activities and to achieve compliance with the BSA and implementing regulations. Second, the program should provide for independent testing of the program. Third, the program rule requires the designation of an AML officer for each investment advisor. Fourth, the program should provide for ongoing training for the advisor's employees and certain others. And finally, the program should include implementation of appropriate risk-based procedures for conducting ongoing customer due diligence. And overall of that, the program ought to be approved in writing by the advisor's board of directors or trustees or the equivalent. And then in some situations, the program might be approved also by members of senior management. And again, the release describes those scenarios.
Okay. I have to admit that this rule hasn't been directly on my radar, but I did notice that it mentions taking a risk-based approach. What does the risk-based approach require for IAs under this rule?
Thanks. Yeah, the program requirement in particular is described in the release as being risk-based, meaning that an advisor should tailor its program according to the specific risks presented by the advisory services that the IA provides and the advisory clients that the IA advises. And so the risk-based approach means that an advisor can focus aspects of this program on activities or clients that the advisor considers to be higher risk and apply more limited measures to the clients or activities that the advisor considers to be lower risk. And then again, the adopting release provides some guidance on how an advisor might think about its risks and address those risks under the new rules.
A couple of the members of our audience who are duly registered ask, what do we got to do? We're duly registered. We're already under these requirements as a BD or as a bank or bank subsidiary. So what's the deal with the duly registered?
Yep. If dual registrants or investment advisors that are also banks or bank subsidiaries are already subject under those rules for having AML programs. And what the release explains is that such an advisor in that kind of a corporate structure does not need to establish a separate program to satisfy the advisor's obligations here. And instead, the IA's program might be part of a comprehensive program that oversees the entire business. That comprehensive program must address all of the advisor's activities that are covered by this new rule. And that comprehensive program should be designed to address the different illicit activity risks posed by the different aspects of the overall business's activities. And then the approach is the same if an advisor is a subsidiary or other affiliate of another financial institution under the BSA. They can extend one program to all entities as long as the program is designed to identify all of the risks posed by the business and satisfies each of the BSA requirements to which the affiliates are subject.
I want to take a few moments to discuss a couple of the reporting requirements for IAs under the new rule. What does the SAR filing obligation require?
Yep. SAR stands for Suspicious Activity Report. And under the new rule, an investment advisor must file a SAR with FinCEN to report certain transactions that are conducted or attempted by, at, or through the advisor. There is a $5,000 threshold for SAR filings, and SAR filings are required only when the IA, quote, knows, suspects, or has reason to suspect, close quote, that the transaction falls into one or more of 4 different categories. One such category is that the transaction involves funds derived from illegal activity. And suspicious transactions are those that, among other things, have no business or apparent lawful purpose or are not the sort of transaction in which a particular client would normally be expected to engage. The thing we would highlight here is that an IA must use an objective standard when determining whether it is obligated to file a SAR. When the IA, again, quote, knows, suspects, or has reason to suspect certain suspicious transactions. And the adopting release have some guidance on this concept, recognizing that the standard should not require an advisor to collect additional information beyond that available through the account opening process and in the course of processing transactions.
I'm looking at my clock. I'm seeing that we're a little bit behind on our time, so I'm going to skip ahead. I know there's a currency transaction reporting obligation too. I understand that it's unusual for the IAs to be handling currency, but if you are an IA and you're handling a currency, take a look at the rules relating to currency transactions. Last thing I want to ask you today, Matt, is practical steps. The compliance date is January 1, 2026. So what should all the compliance folks attending this conference, what should they be thinking about now to prepare for the compliance date?
Definitely read the text of the new rules and the adopting release, which again was adopted or was issued right before Labor Day in August of 2024. There are lots of useful explanations and guidance in that release. For example, the release addresses how an advisor might delegate certain responsibilities under their AML programs and explains who can serve as the required AML compliance officer. And then another thought there is that there are resources available for other financial institutions that have equivalent obligations. These resources are not designed for IAs and in most cases predate the adoption of this new rule, but those resources can provide useful background about the obligations and they might raise points or information for an advisor to consider in satisfying the new rules. For example, the Division of Examinations here at the SEC maintains web pages called AML source tools, and those have useful background information with respect to broker-dealers and mutual funds. And that might help be sort of food for thought for an advisor as it's considering what its own how to satisfy its own obligations under the new rules. And then the other thing we would mention, and this is described in the release, an advisor might start to think about its relationships with other financial institutions under the BSA and with other businesses to which the advisor might delegate some responsibilities under the program rule. The adopting release explained that FinCEN chose the compliance date of January 1st, 2026, so that advisors have over a year to renegotiate or amend contracts if necessary to address or to permit delegation under the rule and have their compliance obligations here all set to go for that compliance date.
Thank you.
Thanks, Steve.
We only have a couple minutes left. I'm going to turn it to Jim because we didn't want to ignore the investment company world, who's already subject to the AML rules, and there has been enforcement activity. And Jim's going to talk to you a little bit about that. And Jim, we're almost out of time, but can you summarize quickly what is happening in enforcement on the AML requirements for investment companies?
Yeah, absolutely. So I just want to talk briefly about the FinCEN rule that requires mutual funds to develop and implement AML programs tailored to their own business structures, including certain minimum requirements which are detailed in the rule. And just to be clear, this is not a new rule. This one has been in place since 2002. So in developing an AML compliance program, mutual funds must identify the vulnerabilities specific to their mutual fund business and design procedures and controls that reasonably assure compliance with the BSA requirements, and which are reasonably designed to detect activities indicative of money laundering. The FinCEN rule also requires that a mutual funds AML program provide for ongoing training for appropriate persons. And we as SEC enforce that rule through Rule 38A1 under the Investment Company Act. So in September of last year, we brought a settled action against DWS Investment Management Americas, Inc., or DIMA. DIMA was a subsidiary of Deutsche Bank AG and advisor to the DWS complex of mutual funds. So we charged DIMA, the advisor, with causing the DWS mutual funds to violate Rule 38A1 by failing to develop and implement an anti-money laundering program reasonably designed to ensure that the mutual funds complied with the Bank Secrecy Act and other applicable FinCEN regulations. So in that case, the mutual funds had adopted an umbrella AML program that was in place for various Deutsche Bank entities and which did not address the specific requirements for the mutual funds business. So the main takeaway here is that mutual funds and advisors to mutual funds should ensure that their AML compliance program is tailored to the specific risks of their mutual fund business. Adopting a global compliance program that was really designed for a different type of financial institution is not going to satisfy the requirements of the rule.
Thank you so much, Jen, and thank you so much, all the panelists, for providing all of your insights today. We are concluding this panel. We are done with panels, and I'll kick it back to Vanessa or Marshall or Keith or whomever is signing off. Thank you so much.
Stephen, thank you and all of the panelists for so expertly addressing each of the topics in such a short period of time. As we started the conference this morning, Chair Gensler noted that at its best, compliance should be so much more than simply ensuring that the regulatory rules are followed. In the Division of Exams, we are committed to partnering with CCOs to empower compliance programs that are broadly and robustly supported by a dedicated tone from the top. Keith, with that, would you please close the conference for us?
Thank you, Marshall, and thank you very much for attending today's conference. I know that I, for one, learned a great deal, and I hope you did as well. I would like to thank all of our moderators, panelists, and everyone who joined the 2024 Compliance Outreach Program National Seminar. We believe that events like this help foster compliance with our laws and rules and supports our mission of protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. A variety of topics were covered today, from information security protections, marketing and advertising oversight, and specific topics related to investment advisors, private funds, and registered investment companies. I hope you were able to take away additional information that will benefit your firm. As the chair alluded to earlier, it is great that this conference falls near a notable anniversary. It is almost exactly 20 years since the compliance date of the Advisors Act and Investment Company Act compliance rules, which was the genesis for the SEC's Compliance Outreach Program. And I want to very much thank the industry participants for working with us in this important program. Specifically, I would like to thank our outside industry experts today, Cheryl Zabala, Stephanie Way, Michael Noose, Karen Vincent, and Jim DeSedecki. Your perspective is truly invaluable. Additionally, I wanted to thank the wonderful core team of cross-divisional representatives from exams, investment management, and enforcement, particularly their AMU unit, that were responsible for organizing the event and for being so gracious with their time. Cross-collaboration between various divisions and with industry not only helps us internally, it helps us create a more meaningful event. And speaking of meaningful events, I want to encourage you all to submit feedback on our conference to ensure that we are making the best use of your time. There's an online evaluation form posted to www.sec.gov under the Compliance Program Outreach area. Please take some time to fill out these evaluations to help us in shaping these events, as your feedback is always appreciated. Finally, I want to thank the amazing SEC staff who organized this event. It is truly a monumental task, and they did such a great job. So a special thanks to Mavis Kelly and Lucas Tepper, Keith Canyon, and Karen Stevenson. I also want to thank the AV team, who I knew had to work through a number of challenges here today. And finally, I wanted to thank Marshall and Vanessa, not only for emceeing today, but also for their leadership as co-chairs of the event and of our IAIC program. And with that, our conference comes to a close, and I hope to see you all next time.